The second lecture of the financial statement analysis is the liquidity ratios. Liquidity ratios are very important to understand because it gives you how you perform your business as the current assets and the current liabilities. I am Dr. Safdar Hussain Tahir, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. Postdoc, UWA Business School, the University of Western Australia. The liquidity ratios are important and they are the current ratio and the quick ratio. Before going in the discussion of the liquidity ratio, it would better to understand the words liquid. You know, water is liquid and honey is also a liquid. But the liquidity of the water is more as compared to honey because when water converting from one shape to another shape, it take less time and lose less volume as compared to honey. So the liquidity is a comparative statement. One asset may be more liquid and yet another asset may not be more liquid as that. So it is not an absolute terms, it is a comparative terms. An asset that requires less time and experience minimum loss in value when changing its form is considered to be a more liquid. We have a two ratios. First one is the current ratio, and then we have a quick ratio or asset test for liquidity ratios analysis. Again, look at the balance sheet. We have a five big component: current assets, plant assets, and intangibles, current liabilities, long-term liabilities, and owner equity. And we focus on the current assets and the current liabilities. It means how much cash that we have to pay our current liabilities. The liquidity ratio of the BW is this, and it is 2.39. It shows a firm's ability to cover its current liabilities with its current assets. It means you have a $2.39 in your wallet to pay $1 liabilities. Similarly, you can compare the liquidity ratios with the industry, and it gives that BW has a stronger liquidity ratio than the industry average. It means that the BW have a more capability to pay the current liabilities as compared to the other industries. Look at the current assets. Current assets have a five different components: cash, marketable securities, account receivables, inventories, and prepaids. So the inventory is confusing. That inventory may take more time to convert into cash because it sell first and then we receive the cash and then converting into cash. So for asset test, we we deduct the inventories from the current assets and calculate the ratios. It gives ability to meet the current liabilities with its most liquid asset because only the inventory which is a less liquid as compared to others. So that is why we deduct it from the current assets. Similarly, you can compare the asset test with the industry. Ratio is weaker than industry average. This ratio is weaker. Industry average is good as compared to the BW. The ratio analysis is given a picture that the current ratio BW 2.39 and industry is 2.15. Asset test is a 1 and 1.25. Stronger current ratios and weak asset test ratios indicates a potential problem in the inventories account. So there is a problem in the inventory. Note that this industry has a relatively high level of inventories. The current ratio of BW has been rising at the same time the asset test ratios has been declining. The grunt ratio of the industry has been rising slowly. At the same time, the asset test ratio has been relatively stable. This indicates that the inventories are the significant problem for the BW. Go and then do the analysis with the inventories. What is wrong with that inventory is important. So we should focus on where is the fault and try to reduce that fault or remove that fault. Thank you so much for your watching. Keep watching, please.